So FOMC just, well, Jerome Powell finished about half an hour ago, 45 minutes ago. But there's a fair bit to unpack, not in the least. The European Central Bank had a surprise emergency meeting trying to deal with the Italian fragmentation fears, and they're going to be pumping extra cash into the sovereign bonds. So that saw some effect on European stock markets, which we can see over here in the Euro stocks and the DAX, the two major ones, had a bit of an upswing. But the big one was FOMC, clearly, and they went to 75 basis points. I was kind of hoping for 100 basis points, pushing it up to 2.5. And watching Jerome Powell's press conference afterwards, kind of blaming everybody for the failure of the Fed, saying that it was the war in Russia, it was China's COVID lockdown, it's the supply constraints, whilst demand is still quite high. He said he's not seeing any signs of demand dissipating in the market, even though retail sales clearly here shows, only half a day beforehand, or that morning of the Fed, that retail sales is quite weak. So, and most other indicators people are watching are showing that the retail sales are quite weak. So the dot plot shows target is going to be up at 3.8%. The dot plot is where the Feds expect all the members of the Fed put their expectations of where interest rates will be by the end of 2022. So the average there is around 3.8, just over around 3.5. In 2023, you're closer to 4%, and then dropping down to sort of just under 3.5. 2024, zero hedge showed that in a line like this. So it's a little more easy to see. So, remarkably optimistic is of a soft landing is what they were trying to iterate. They were saying, we're wanting to combat inflation. We're going to be raising rates to do that, but we want unemployment to remain strong as well. So that's the soft landing, right? So unemployment going back up to 4%. He said we don't want to for people to lose their jobs, but that's the ideal economy, is where interest rates are, job rates at 4% from the current historic low of 3.6%. So job rates at 4%, and the headline interest rates are at 2.5%. That's his optimal sort of setting, with inflation around 2.2%, or the low twos. Inflation, interest rates, that's inflation, that's interest rates, and that's jobs. That's his ideal setting. But by moving the interest rates up this fast, moving interest rates up to sort of 3.6% from where it was at under 2%, 0.2%, that it's only going to move jobs by 0.5%. That's unlikely. So expect an overshoot, and then the market to potentially crash into recession. That's what most people would be expecting. Let's go and have a quick look at prices. So the VIX certainly came off, as everybody thinks, it's all good, and the typical reaction of Fed fighting sees the stock market rally. But interesting to note is that if we look down here, S&P 500 rallied after the Fed rate decisions, only to make lower lows post the Fed rate decision. So don't be surprised for that to happen again. What I would expect here is the next couple of days will be pretty tricky as the market digests what's happening. But you might see a bit of a relief rally even in Australia, but more on that later. Certainly the US stocks, you might see a relief rally back up into this area here. That's the Nasdaq. S&P might sort of get back up to 4,500 or 40,050. But then you'd be looking for a sell-off, because the underlying issues that Jerome Powell says he can't control are still there. You know, the shipping containers are still blocked up for supply chains are still blocked up with months of delay. Oil prices are still rallying, and that's off again supply constraints, but also particularly the Russian-Ukraine war, which is quite a large portion of the gas and oil supply market. Oil has come off a little bit today, but we're at still very elevated prices. Natural gas up a little bit, copper up a little bit. So the headwinds that Jerome Powell's talking about and says he can't control, and so to a certain degree he can't. He's not a politician in that sense, not controlling fiscal policy. Those controls are still out of his, or those issues are still out of his control. So I don't think the 75 basis point move is going to have a lingering effect on stock markets. There's no reason for us to be buying with exuberance. So as Adam suggests, there's nothing in the FOMC that screamed it was time to sell the dollar or buy risk trades, right? But that's what happened. People started buying risk trades, i.e. the stock market, and sold the dollar. What he does note, which is also a fair point, is that there's always fear and angst ahead of the FOMC, and there might be that pullback post the move. So if we go and have a look at the US dollar majors, what that's suggesting is that this rally up is going into the FOMC, that fear and angst, and then there will be a pullback to a certain degree. And we had that last month as we rallied into the FOMC, and then post FOMC there was that dollar drop, only to see it rally again. And we do have another FOMC meeting at the end of July. So the next FOMC is the 28th. Yeah, 28th of July is the next one, and they're talking about another 50 or another 75 basis points. Then they will get an inflation number, another monthly core inflation figure before that. So they'll have something to gauge whether or not their raise today is having an effect on the market. But certainly we can see that it's already, even the move last month is already having an effect. You can see it on retail sales, where the consumers are starting to pull back their spending. And he did mention in the presser that they watch the consumer spending closely, because consumer spending is 60% of their GDP, of the economy, right? 60% of the economy. So how the consumer goes, so does the economy. And if people are worried because petrol prices are going through the roof, mortgage repayments are getting more expensive, they're going to have less money in their pocket to spend on consumer products, and therefore you're going to have that economy pretty much crash. There's already starting to see some weakness in the economy, even though he said we're not seeing it yet. I'm not sure what he's looking at if he's not seeing it. So I expect that we're going to have the US dollar have a little bit of a pullback over the next couple of days. It's going to be tricky to trade, but I'd still be in favour of buying any sort of dips when you see that sort of turnaround, when the market starts to get stronger again, off a sort of a good support level. So somewhere around here, and let's just look at the dollar index on a technical basis, right? So if we look at this area here, and we put a fib on that from this move here to up to there, the 61.8 fib comes in around that zone. So this is where I'd be sort of interested in getting long the US dollar when it gets back down there, buying that next rally, because I don't see this picture changing anytime soon. If we go and let's have a look at US bonds, would have had a bit of a sell-off overnight. So we've got down 5% post FOMC, bonds are going this direction, so that's natural for the US dollar to have that pullback. But again, the US bonds, this particular trend is up 68% from the lows down here in this time last year. It's up 68%. That's US bonds, right? Bitcoin is the opposite of that. It's down 68%. So as this goes, so will dollar index. So I would expect, if you've got the bonds trading at 3.29%, but their projections from the FOMC is for the short end, the overnight rate to be at 3.8% by the end of the year, then you would expect the 10-year bond to be higher than that. But with the recession expected next year, then the long-term curve should sort of look like that. So keep an eye on this one and the US dollar index. Looking forward today, what we have is Aussie unemployment. That will sort of be a key indicator for the RBA next month, early July, where we're expected to raise rates, but how far will probably be designated by the unemployment rate and certainly the wages at the same time. Then later this afternoon we've got the SNB, then tonight we've got the BOE, followed by tomorrow's Bank of Japan. So still a bit of volatility to come for the rest of the week. Obviously not as much as what we would get from the Fed, but trade with caution and trade what you see. I'd still advise short-term trading rather than the sort of long-term view at this stage. Aussie dollar back above 70 cents. Again, see no reason to be buying the Aussie dollar at this stage. However, we do have a higher low here, so that'll be interesting to monitor whether or not if we get another sell-off, if we can make another lower low, or we start pushing back up this direction as China comes out of lockdown. Pound, tough one, but you've got the BOE tonight, so I wouldn't be playing in that. And the euro dollar, despite what the ECB is doing and what the Fed's doing, the euro dollar is finishing a little weaker. Yen off. Again, you might look at that support level there to bounce it, and Swissy, lower high. Canada, it's just a tough one. It's still in that range, right? That 129, effectively 129 to 124 range. And that's where it's been for the best part of a year. It's a tough one to trade. Rightio, indices, probably get what they call a dead cat bounce or a relief rally, and that's about it for the day, guys. Take care out there. It's going to be pretty volatile and tricky. A couple of sessions coming up until things sort of settle down a bit.